As you watch this video, a hidden housing crash is happening right now. The real estate market has entered into crisis mode, and in 2023, a disaster is waiting for us that could be worse than what we saw in 2008. While many remain doubtful due to some conflicting reports, fresh new data points to a worrisome future. One of the first things you will hear from crash skeptics is the fact that nationwide prices are showing no indications of a downward trend, and this is relatively technically true. The most famous and commonly used index to estimate home prices in the United States is the Case-Shiller Index. So you may be asking yourself, what's next? Well, hopefully, what's next is you hitting that like and subscribe button. Now coming back to the main topic. According to the latest reading for September 2022, home prices have declined since their peak in June by only a tiny 2.5%. So because of this, many like to point out that homes are simply cooling. A crash is out of the question as we're still 38% higher than pre-pandemic levels, but this measurement isn't capturing what's happening on the ground right now. The Case-Shiller is infamous for being a lagging indicator. If you dig into the technical details of how the Case-Shiller Index is developed, what you see is that it uses an average number that looks back nearly 3 months. This means that while home prices could be collapsing, the change wouldn't look as intense on the Case-Shiller, especially in that initial phase where we see the first signs of a downtrend. We can prove this by looking at Redfin numbers. As you may already know, Redfin is mainly a real estate listing platform, and they have some of the biggest real estate data sets in the world. Not only are their numbers accurate, but they're also fast. Redfin can look at listings in real time and figure out averages without drilling through county records, which are often delayed and lagged behind the prices we see listed on websites like Zillow and other prop tech corporations. Essentially, the Case-Shiller is a great indicator, but like many others, it often lacks what's going on in the markets in real time. So the top question is, what do these numbers say? Well, as I mentioned earlier, the Case-Shiller peaked in June of 2022, while the Redfin numbers peaked in May, 1 month before the Shiller. Now, this may not seem like a big deal, but if we go in detail, we can see an obvious variation that explains why so many investors are panicking. Looking at the drop in the Shiller, we can see that prices have fallen 2.5% from top to bottom. Meanwhile, in the Redfin report, prices have already fallen 12.6%, and that's a huge difference in the real estate world. Remember, typically prices hardly move year by year, and to see a 13% drop in a few months is a massive warning that should tell you everything you need to know about the future of this market. At the end of the day, the Case-Shiller is not just keeping up with how quickly this crash is shifting. The crash is already underway, and it's not just finance YouTubers who are talking about it. It's prominent CEOs that work in the industry. Lance Lambert of Fortune magazine recently spoke to CoStar CEO Andy Florance. The CoStar is considered by many to be a global leader in commercial real estate analytics and information, and the CEO was very clear about where he feels this market is going. He said, "People who think a 10% drop in home prices is what's coming are dreaming, and a 20% dip is more comfortable." Institution after institution are making similar comments about it. KPMG, one of the largest and most decent accounting companies in the country, just yesterday notified that they expect the Case-Shiller to drop 20% by the fourth quarter of 2023, and remember, this is the national average. In pumped up markets, the damage will be incredibly worse. For example, in Boise, Idaho, which was arguably the most inflated market in the US after the pandemic, prices there have already collapsed by over 20%, despite the national average being down just 13% by Redfin numbers. This is more than double the norm, and dozens of other American cities fall into the same inflated boat. If national prices are down 13%, according to what is likely the most precise up-to-date figures and in markets, they're already down more than 20%. Where's this all directed? Well, according to many, this may end up worse than 2008. The number one topic when experts examine a crash like this, everybody knows that in 2008, the housing market crashed due to bad loans. This was dramatized in the infamous movie The Big Short, And basically, what happened is that loans got too easy to obtain. Home ownership soared, but not in a good way. Too many people were buying with income that didn't match the debt they were inheriting, and on top of that new subprime, markets allowed people to jump into loans with teaser rates that created a fantasy of affordability. This all exploded with the subprime market blowing up, and soon after, housing went into a long spiral downtrend along with the entire economy. But today, loans look entirely different. The norms have improved, the rules have been changed, and the subprime market is essentially non existent. So, if that foundation is reliable and healthy, what could cause the market to shatter? Well, the answer is pretty obvious, but for some reason, it isn't talked about. It's investor withdrawal, and for the past 10 years, big Wall Street investors have come in and altered the single family home market. All kinds of organizations, including Opendoor, Redfin, Zillow, and countless others, have jumped into markets and begun spending on real estate. This is what they call iBuyer programs. Essentially, it's a business where you can get an instant proposal for your house, and this gigantic company will come in and buy it for cash. This changed the market because these offers are often more than suitable. In fact, in many examples, companies were offering much more than would look like to be the perceived fair value. These were massive tech props, unprofitable giants that weren't focused on profits but rather on growth. So, in many instances, these massive institutions were facing off for market share. They were trying to buy up entire cities, even if it meant losing some money on each property. What this did is create a set of circumstances where prices soared. iBuyers were purchasing hundreds of thousands of homes and relisting them for ridiculous amounts of money and inflating entire markets. This worked for many years, especially in the post pandemic boom, as remarkably low interest rates and a euphoric environment helped push prices along at a pace we've never seen in history. It was entirely a self feeding loop as these companies inflated entire neighborhoods. It attracted mom and pop investors, smaller operations who practiced the real estate churn mentality, like bought a house, changed the floor, painted the rooms, waited a couple of months, and sold for extreme profit. This type of behavior further inflamed prices, and what was left is this: a situation where investors represented a large share of buyers. According to Redfin reports, in Q4 of 2021, investors bought nearly 1 in 5 homes in the United States. This is even citing the fact that in other cities, this number was even higher. In Vegas, for example, nearly 30% of all homes sold in that quarter went to an investor, and these numbers are probably diluted with other data, just using simple logic. If we took out the homes that were sold via confidential deals and only looked at mid priced homes sold in attractive neighborhoods, that percentage would surely rise to something absurd. The reality is that investors at one point last year have practically taken over the market, and this is now all exploding, leading to the final point. The source of this collapse will not come from bad loans, instead, it will come due to the iBuyers. We've already seen Redfin essentially liquidate its single family holdings and fighting its bankruptcy with others. It's only a matter of time before we see the complete withdrawal of investors from the market. Remember that in 2008, subprime mortgages as a share of total mortgage origination only ever reached a high of 13%, and that 13%, even when diluted by everyone else who already had a mortgage and those that had mortgages paid off, was enough to bring down the entire market. 13% of loans were bad, and everything went under. Now, with nearly 15 to 20% of all homes going to investors, what happens when they all pull out at the same time? The same mechanisms that cause prices to rapidly rise will now do the opposite, especially at the pace of higher rates and a slowing economy. When you look at companies like Opendoor, which lost $928 million in Q3 alone, you have to wonder about the future of this pace. Many claim that the company is on the brink of bankruptcy, and it's easy to see why. A post by Kevin Magna captures the problem in one screenshot. In the suburbs of San Francisco, you can see that Opendoor simply can't move its inventory. In this case, they listed a home for $2.2 million, And now, almost 6 months later, it's still for sale with a price cut of nearly half a million, and this is just one deal. Multiply the system thousands of other times, and you can see exactly why many are wondering how many months this company has left and how much the entire industry will suffer when or if they liquidate. Whatever the case may be, we're in for an interesting 2023 as iBuyers and investors flee real estate following record breaking price collapses. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoy it, and don't forget to drop a comment below as I'd love to hear from anyone that sold their house to an iBuyer in 2021 or 2022.